You know, imagine you are looking at a submarine sonar screen.
Okay.
Usually you just see the contours of the ocean floor, right? Maybe a school of fish. It makes sense. It's predictable.
Right, standard stuff.
Yeah, but then suddenly this massive, unidentifiable object just takes up the whole screen. You don't know if it's a glitch, a whale, or like an enemy sub.
Yeah, that would definitely get your attention.
Exactly. And when something like that takes up your whole screen, you don't just stare at it, you analyze it. And today, we are analyzing the biggest anomalies on the market's radar right now. Welcome to this deep dive.
Glad to be here.
So our mission today is laser focused. We are mapping out today's most extreme market moves, unusual volume, and price action anomalies. And we are doing it strictly from a trading and smart money positioning perspective.
And we really do have a fascinating stack of sources to guide us through this today. I mean, we are pulling from real-time technical trading levels, quantitative macro research that tracks institutional asset allocation, and even some high-level geopolitical intelligence just to piece together the broader puzzle.
So if you want to know exactly where the smart money is rotating right now, why a massive legacy stock just ripped 150%, and the specific, absolutely critical must-break levels that are dictating the market's next move, well, you are in the right place. Okay, let's unpack this.
Let's do it.
Starting with the biggest blip on that sonar screen we just talked about. We are seeing a legacy healthcare stock acting, completely out of character. It's trading like a meme stock.
Yeah, we're talking about mRNA here.
Right.
The stock just experienced this staggering 150% equity move to the upside. And this wasn't, a slow, methodical grind higher. It was an absolute explosion.
Vertical.
Exactly. Completely vertical and driven entirely by news of a highly tailored, individualized cancer vaccine.
150% rip on a legacy biotech name is just insane.
It really is.
But for anyone out there looking at the charts, you can't just chase a vertical green line, right? You have to know where the institutional algorithms are actually sitting and waiting for their entry.
Well, the technicals on this setup are basically textbook right now. mRNA shot up, and then it hard rejected near its weekly high.
Around what level?
Right in that $170 to $178.50 supply zone. That is where the early institutional buyers stepped in to secure their profits, basically creating a temporary ceiling.
Right, taking some chips off the table.
Exactly. So if you are an algorithmic trader looking for the optimal smart money buy zone on a pullback, you have to look down at previous triple top resistance.
Okay, and where is that sitting?
That zone sits right at the $115 to $122 level, which, should now act as heavy support.
Wait, let's pause there for a second. Conceptually, why does that actually happen? Why does a price ceiling suddenly become a floor just because a stock finally broke through it?
It really just comes down to basic market psychology and order book mechanics.
Okay.
Think about all the traders who sold at that 115 to 122 ceiling over the past few months, right? They were thinking the stock just couldn't go any higher.
Right, they thought they were out at the top.
Yeah, and then once it violently breaks out past that level, all those sellers suddenly realize they made a huge mistake.
Oh, the regret phase.
Exactly. Meanwhile, you have other buyers who totally missed the initial breakout, and they're just waiting for a second chance. So when the price eventually pulls back down to that 115 to 122 area, all that pent-up regret just turns into fresh buy orders.
So the old ceiling literally becomes a new floor made of fresh demand. That makes perfect sense. The market is just absorbing the regret of the people who missed the boat.
That's a great way to put it, yeah.
And if this new floor holds, and mRNA manages to flip that $178.50 overhead resistance into new support?
Well, flipping a 178.50 opens up a very real, mathematically modeled technical pathway for the stock to just run all the way back toward its historical COVID-era highs.
Wow.
But, zooming out a bit, this mRNA explosion in the healthcare sector, specifically the XLV ETF, it isn't an isolated event.
Right, it's bigger than that.
Yeah, it is a symptom of a massive underlying smart money rotation.
Because we are officially entering what the institutional research in our sources is calling phase 2 of the AI trade.
Exactly. Phase 2.
We all know about the $1 trillion in hyperscaler capital expenditures, right? Google alone is dropping $190 billion this year just on building out their AI infrastructure.
Yeah.
But the destination for that capital, it's starting to shift.
What's fascinating here is tracking where that money is flowing next. Capital is rotating out of the Magnificent Seven tech giants, and it's flowing downstream into the AI
The
beneficiaries.
physical world companies.
Yeah, these are the legacy companies using AI to drive massive, tangible productivity gains and, real cost savings.
Like John Deere. The sources point out that they are literally putting AI-powered cameras on tractors now.
Yeah, the precision ag stuff.
Right, to selectively spray individual weeds instead of just crop dusting entire fields. The cost savings on chemicals for farmers there are just astronomical.
Massive.
Or you look at Caterpillar, or the huge energy grid companies that are absorbing the intense power demands of all these new AI data centers. It's like we've spent $1 trillion building the world's fastest, most advanced highway, and now the smart money is finally taking their profits and buying the shipping companies that actually get to use it.
That is spot on. The market has fully priced in the infrastructure build-out phase. Now the institutional algorithms are just hunting for the margin expansion that the new infrastructure provides to non-tech sectors.
Right, the second-order effects.
Exactly. That is where the hidden value is sitting today.
But, okay, let me push back on this. If smart money is aggressively rotating out of the Mag 7 and just buying up tractors and energy grids and biotech companies, does that mean the semiconductor trade is officially dead? Are the institutions just done with the chip makers?
The semiconductor space is certainly not dead, no. But I will say, it is currently resting on a razor's edge. Yeah. To see this, we just have to look at the SMH, the semiconductor ETF. It recently executed a rather brutal bear trap right at $527.87.
Meaning the SMH essentially baited retail short sellers by dipping below that key 528 level, trapped them losing positions, and then immediately used their forced buying to squeeze the price higher.
That is exactly what happened. It was a pure liquidity grab, perfectly executed right at the daily 100 simple moving average.
The big players needed that liquidity.
Yeah, they needed those retail short sellers to create enough liquidity so they could fill their own massive buy orders, without spiking the price too quickly.
Classic.
But despite that successful squeeze, the SMH is now slamming its head against a massive must-break resistance level.
Where's that at?
Right at 563 to 567. It's like it's hitting a ceiling made of concrete right now. And if it fails to break through, there is a dangerous downside gap on the chart waiting to be filled all the way down at $548.50.
Here's where it gets really interesting. The technical hesitation on that chart completely contradicts the fundamental data we are seeing from the big banks right now.
Oh, absolutely.
I mean, we're looking at quantitative notes from Bank of America suggesting NVIDIA might actually be 50% undervalued right now based on its free cash flow, especially when you compare it to industry peers like AMD and Marvell.
The disparity is striking, honestly. The undisputed king of the entire sector might be trading at a massive discount, yet the broader sector ETF just cannot break through overhead resistance.
It's wild.
And Bank of America is utilizing a sum of parts free cash flow model to arrive at this because, while retail traders are sweating over NVIDIA's whole circular financing narrative, the smart money institutions aren't panicked by it at all.
Just to clarify for everyone listening, that circular financing narrative, that's the idea that NVIDIA is investing heavily in AI startups like OpenAI and Anthropic, who then just turn around and use that exact same investment money to buy NVIDIA chips.
Right.
It basically looks like NVIDIA is just buying its own revenue.
Which naturally makes traditional analysts very nervous.
Right. It looks like a house of cards.
It does on the surface. But what the institutions are actually laser focused on is how NVIDIA utilizes stock buybacks to counter that exact dynamic.
Okay, break that down.
Historically, NVIDIA has used a much lower percentage of its free cash flow for buybacks compared to its peers. If they increase those buybacks, they effectively offset those off-balance sheet startup investments.
How does that math work in practice, though? Like, how do buybacks actually erase that circular risk narrative?
Think of it as a balancing act on a scale. On one side, NVIDIA has cash tied up in these highly speculative, illiquid equity stakes in startup.
Right, which represents a lot of risk.
Exactly, that's the risk side. But on the other side, by taking their massive free cash flow and buying back their own stock on the open market, they are retiring shares and returning cold, hard cash directly to the shareholder. Yeah, they are mathematically shrinking the supply of their own stock, which automatically concentrates the value for remaining shareholders. And that easily outweighs the venture capital risk on the other side of the ledger.
Okay, so we have this glaring contradiction staring us in the face now.
Yeah, we do.
The underlying fundamentals and the cash flow model say the undisputed king of chips is massively cheap,
Hmm.
but the actual stock chart says the sector is hitting a brick wall and might fall through the floor to fill that gap. Why the disconnect?
It's because technicals often front-run fundamentals when the broader macroeconomic weather starts turning ugly. And right now, the macro weather is being completely dominated by a massive gravitational pull from the global bond market.
Oh man, the yield pressure out there is historic right now.
It really is.
We are looking at alarming milestones driven by global capital competing for returns. Just to give you some context on this, we are seeing sovereign bond yields spike globally. The 30-year nominal U.S. Treasury just hit 2007 levels.
Which is huge.
Yeah. The German Bund hit 2011 levels, the French OAT hit 2008 levels, and the UK gilt is all the way back to 1998 levels. The U.S. 10-year yield is currently in the mid to high 4% range, but it's pushing ominously toward a danger zone of 5.5%.
And if we connect this yield spike to the equity charts we were just discussing, it completely explains that concrete ceiling.
Right.
That yield pressure creates a suffocating overhead resistance for stocks. Because when the risk-free rate of return rises, meaning what an investor can guarantee they will make just by holding safe government debt, the valuation multiples on risky assets like stocks, they simply have to compress to remain competitive.
They just get pulled down.
Exactly. We see this gravitational pull playing out perfectly on the major indices right now.
Because that 5% yield basically acts like gravity on stock valuations, algorithmic traders are drawing hard lines in the sand.
Yep.
Looking at the actionable levels for the S&P 500 through the ES futures, it is facing a hard, undeniable rejection point at 7,700. If it stays below those 7698 to 7700 overnight lows, the immediate downside technical target is 7650.
And the setup on the NASDAQ is even more precarious.
Yeah.
It absolutely must hold its daily 20 moving average, which is sitting at 29,160. If it breaks that support level, there is just a total vacuum of demand down to a gap fill at 28,964. And honestly, momentum could easily drag it all the way down to 28,700 before it finds a true floor.
But let me play devil's advocate for a moment here.
Sure.
Corporate earnings are up roughly 30% year over year. Nominal GDP in the U.S. is growing at 5 to 6%.
Right.
If the economy as a whole is growing nominally at 6%, shouldn't the average investment comfortably yield 5%? Like, why is the stock market so panicked about a 5% 30-year bond?
It's a fair question, but it comes down to the underlying cost of capital and the mechanics of debt rollover.
Okay, explain that.
A 5% nominal growth environment absolutely justifies a 5% yield in a vacuum, but we haven't lived in a normal environment for over a decade.
Yeah.
The entire financial plumbing system, the way corporations roll over their short-term debt, the structure of mortgage rates, the massive leveraged buyout industry, all of it was built entirely on a foundation of 0% interest rates.
Ah, the cheap money era.
Exactly. So when the cost of money rapidly normalizes back to 5%, average unleveraged investments survive just fine. But the hyper-leveraged, speculative investments that depend on that cheap debt, they get utterly destroyed.
And that explains where the smart money is hiding right now. Because of that leverage risk, institutions are aggressively rotating into defensive, tangible assets.
They want safety.
Right. Our sources highlight quantitative models, specifically the KISS macro portfolio model, and they have completely dumped Bitcoin. They are sitting at 0% maximum exposure.
And that's because the quantitative signals for Bitcoin broke down into bearish volatility bands.
They aren't looking at the news at all, are they?
Not even a little bit. The models aren't looking at the news narrative. They are looking purely at the math of price swings. It simply became too risky from a systematic perspective as liquidity started drying up at the extreme fringes of the risk spectrum.
But while they dumped crypto, these exact same models maxed out their exposure to gold, sitting at a heavy 30% allocation.
Yeah, heavily weighted.
And gold just executed a perfect technical retest of the $4,500 level. According to the data, as long as it holds above $44.95, it remains the prime smart money safe haven.
And we are seeing a similar defensive hard asset breakout in energy right now, too.
Oh, definitely.
Crude oil is holding really strong above $86 a barrel, and that is driving massive algorithmic strength into energy equities. You have stocks like Occidental Petroleum, OXY, executing a major technical breakout over $61.24.
So institutions are basically hiding their capital in things you can physically touch, burn, or wear.
That's exactly it.
So we have the global bond market threatening to basically derail the entire highly leveraged equity complex. But governments aren't just sitting idly by watching their borrowing costs spike. How are institutions reacting to the government's countermeasures?
This introduces a critical dynamic regarding systemic liquidity. We have to look really closely at the U.S. Treasury's intervention here.
Right, the macro maneuvers.
Yeah, the quantitative research points to a transition into what they call paradigm D, or print the demand.
Our sources also refer to this as Besant's Bridge, right? The Treasury is effectively doubling its buyback program. But how exactly does a Treasury buyback cap yield rates? Walk us through the actual mechanics of that intervention.
Sure. So when the free market demands a higher interest rate to take on the risk of holding 10-year or 30-year government bonds, the price of those bonds falls.
Basic inverse relationship.
Right. To stop this, the Treasury steps into the market and buys up that long-duration risk themselves. By hoarding the long-term bonds, they literally starve the open market of supply.
Creating an artificial scarcity.
Exactly. And that scarcity forces the price of those bonds back up, which automatically pushes the yield down.
But wait, how are they paying for that?
They fund these massive purchases by issuing a flood of short-term T-bills instead.
It's just an incredible maneuver. I mean,
Yeah.
when the market refuses to provide the demand at the price the government wants, the government just prints the demand themselves.
It is a highly coordinated strategy to outrun financial repression and basically keep the global credit system from seizing up under the weight of higher rates.
But that engineered liquidity, the money printed to buy up those bonds, it has to slosh around and go somewhere in the real economy.
It always finds a home.
Right. And we can actually see it finding a home in one of the most highly concentrated private-to-public names on the board right now, and that is SpaceX.
SpaceX serves as the perfect microexample of this overarching macro liquidity environment.
Also,
Well, following its record June IPO, the stock has been incredibly volatile. It's serving as a battleground for all this excess capital. Right now, it is battling fiercely at the $150 level, which, interestingly, was its exact opening print price.
if the algorithms hold that 150 level, the next technical target is 200. But the ownership structure of this company is what makes it so unique to trade.
Oh, it's wild.
Out of over 1,500 total shareholders, just 23 entities own 83% of the stock. We're talking about Elon Musk, the Giga Fund, the Saudi Public Investment Fund, and D1 Capital.
And that extreme concentration of ownership creates fascinating, almost counterintuitive market mechanics, especially when we look at lockup expiration.
Right. Usually when early insiders are legally allowed to sell their shares for the first time after an IPO, you expect a massive flood of new supply to hit the market and just crush the stock price.
To expect a huge dump.
Yeah. Yet the exact opposite happened here. SpaceX recently had a massive $919 million lockup expiration, with another $320 million coming right behind it. Common sense says the stock tanks.
Yeah.
But on that first expiration day, the stock actually went up. Why does that happen?
Because the underlying demand was artificially supercharged, fueled by this overarching environment of engineered liquidity from the Treasury we just talked about, combined with immense retail fascination for the underlying technology. The market just absorbed that new supply instantly.
They just ate it right up.
Yeah, the retail investors eagerly bought every single share the insiders were legally allowed to dump. They essentially acted as a giant wall of exit liquidity for those early billionaires.
So what does this all mean for you? The structural tension here is just incredible. On one hand, you have the Treasury artificially keeping the financial bridge intact,
Yeah.
pumping liquidity into the system to stop the bond market from crashing. On the other hand, you have that exact liquidity flowing downstream into highly concentrated equities, allowing everyday retail traders to just happily buy the top from institutional insiders.
It synthesizes everything we've analyzed today perfectly.
It really ties it all together.
Yeah, the technical charts for SpaceX soaking up supply, the hard algorithmic resistance on the S&P 500, the smart money models maxing out their exposure in gold. None of these are disconnected events.
They're all linked.
They are all direct symptoms of this exact same engineered liquidity environment fighting against the gravity of bond yields.
Okay, let's bring this all together. We have mapped out a massive market rotation today. Institutional money is flowing out of the Mag 7 tech giants and into the Phase 2 AI beneficiaries, like the legacy healthcare biotechs like mRNA, and the physical industrials, like John Deere. We've identified the exact must-break technical levels, with the semiconductor ETF hitting a brick wall at 567 and the S&P 500 facing a hard rejection at 7,700. And we've exposed how the Treasury's yield capping strategy is injecting liquidity that ultimately drives smart money into defensive assets like gold, while retail soaks up concentrated plays like SpaceX.
We are operating in a market entirely defined by contradictions right now.
Yep.
You have fundamentally undervalued chip giants fighting broken technical charts, all while macroeconomic forces and government interventions just pull the strings from behind the curtain.
Which leaves us with a final, slightly provocative thought for you to ponder as you look at your own screens this week. We are currently watching a historical collision of two unstoppable forces.
It's fascinating.
On one side, we have Phase 2 AI. Companies across every sector are using this tech to create massive, genuine, deflationary productivity gains. They are producing more, for less cost, faster than ever before in human history.
And colliding directly into that progress, we have Paradigm D. Governments around the world, drowning in decades of accumulated debt, are essentially forced to engineer liquidity and subtly debase their own currency just to survive the math of servicing that debt.
So the real question you have to ask yourself is this. What actually happens to your technical trading levels when the underlying measuring stick, the currency itself, is being deliberately devalued, while the physical output of the economy is being exponentially supercharged by artificial intelligence?
It breaks the models.
Exactly.
Yeah.
Does a stock chart, whether it's the S&P 500 at 7,700 or NVIDIA filling a gap, even mean the same thing in that world? Or are we just looking at a massive, unidentifiable object on the sonar screen, completely misinterpreting what is right in front of us?
Something to think about.
Keep questioning the data and understand the mechanics behind the moves, because the rules of the game are changing in real time. Thanks for joining us on this deep dive.